So welcome and thanks for joining us today. We're really grateful for your joining us and for our time together. This is a great topic for us. I'm Tony Parisi. I'm a managing director at the investment bank Strategic Exit Advisors, SEA, where our mission is to help people close the biggest deals of their lives. And our niche is helping entrepreneurs sell their businesses. We're joined by three experts in mergers and acquisitions: M&A attorney Harry D. Donato, finance professional Jeff Mitchell, and communications expert Cassandra Bailey. And we will meet our panelists shortly. First, I want to show you a couple of graphics that strike at the heart of the matter of this topic. We can, let's see. Cass, were you seeing my PowerPoint there or something else?
I'm not seeing your PowerPoint just yet. Oh, there it goes.
You see it?
Yes, thank you.
Okay, there's our wonderful new logo and branding. So number one here, this is a study by the Exit Planning Institute that asked business owners, who was your first phone call when you received an offer to sell your business? And the financial advisor there as of 2023 is number one. Over the past 10 years, having moved up from number 5. Attorneys have also moved up. Some people have moved down, but we won't go into those details. But this really, I think, shows empirically what a lot of us have seen anecdotally, which is the wealth advisors, the wealth advisor as an industry, as people have really built themselves as the right-hand person to their clients and business owners, somebody who they confide in and trust and reactively think to reach out to. This is a second study here, and it's essentially something that was done by University of Alabama, also Portland State, and then Northern Trust did a similar study. And what this says is that when business owners use professional advisors, they get a price that's 25% higher than if they don't use advisors. And then the other piece that's really interesting is that 99% number on the right. 99% of private equity owners, of professional owners, use investment bankers. So as we think about this, it really underscores that for a business owner who's going to do one deal, it's in your interest. It's in the business owner's interest to do the same thing that the professional business owners do. So we're gonna jump in based on those two, what we know from those two sets of information. A couple points of logistics. We'll have time for questions. So if you have questions that you'd like to put to the panel, please put them in the chat. Also, we're going to be following up with a one-pager subsequent to our meeting today. So let me introduce each panelist, and we'll ask each of you to talk about one situation, one danger that a business owner faces jumping at a first offer for their company. So Harry, we'll start off with you, please. Harry D. Donato is a corporate attorney at the law firm McElroy Harvey. Harry's an expert in advising clients in the negotiation, diligence, and documentation of M&A. Harry, why don't you please go for it, please?
Okay, thanks, Tony, and nice to be with you all this afternoon. So I understand the question to be to give you one example of an issue that's arisen with when somebody presents that they announce that they're going to sell their business. I'll just give you a general issue that pops up a fair amount, frankly, is that we have clients that will come to us, or new clients to us, that will have already signed a letter of intent prior to approaching any advisor, whether it be a financial advisor, an accountant, or a lawyer. And they don't necessarily understand the pitfalls of signing a letter of intent, because they always say the same thing. Well, it's non-binding. So it really doesn't mean anything. And of course, as advisors, we know that that's not the case. Letter of intents are for the most part, or many of the provisions are non-binding, but not all of the provisions are non-binding. And letter of intents, of course, set the tone for the deal itself. And the purchase price in a letter of intent is usually just it's kind of a headline thing, right? There's so many details that are in letter of intent that need to be addressed and can best be addressed by all sorts of advisors, including the tax advisor, the financial planner. And so really the number one caution is if your client is looking to sell or has mentioned the sale, certainly make them aware of the fact that they should not be signing anything until they've had an opportunity to talk to you and get recommendations from you in terms of who best to engage as an investment banker. As Tony was pointing out, he was saying the professionals use investment bankers. I think, just to be clear about that, buyers, 99% of buyers have financial or investment bankers involved in the deal. So you need to get financial people involved. Your clients need to get financial people involved in the deal from the very beginning. And frankly, 2 years before a deal really should, or 2 years before they are looking to sell their business. There needs to be tax planning. There needs to be income planning. There needs to be structure planning. There needs to be cleanup of books planning. So there's a whole host of issues that need to be addressed well before a letter of intent gets signed.
Thanks, Harry. Jeff Mitchell, we'll pass it to you here. Jeff's a senior vice president at Siegfried Advisory. He's an expert in advising clients and optimizing their business for sale through financial and tax preparation and diligence.
Hello, thanks, Tony, and hello, everyone today. So at Siegfried Advisory, we help businesses and business owners kind of plan for the future growth, whether, through a lot of forecasting and cash flow planning. And what that means in the transactional space is helping those businesses prepare for that exit. In terms of answering your question there, Tony, I think it's kind of similar to what Harry had said. I think, a more of a general answer is that generally if a buyer receives an unprompted letter of intent, it usually means the buyer probably hasn't seen the financials yet. So in some cases that could be a lower valuation. They don't even maybe perhaps know what EBITDA is or what the true valuation should be. So how could they really assess an offer? And sometimes if it's a strategic buyer, it might be higher. But in some cases it might be lower. And, I think what would be preferred, as Harry said, is to do some proper planning well in advance to kind of understand what your EBITDA is and be prepared and proactive with seeking letters of intent. Just that unprompted one doesn't really give you the opportunity to do proper tax planning as well. So it's kind of you're starting a little bit behind the 8 ball. So I think, although in some cases it could work out fine, our advice and our approach in dealing with business owners is to speak to them much farther in advance to kind of prepare for that step.
Yeah. Says The Sopranos. Paulie Walnuts once said, "You don't even know what your EBITDA is."
Right.
So, Cassandra Bailey is the CEO of Slice Communications. Cass is an expert in advising clients in communications and public relations, internal and external, in order to build trust with companies' employees, clients, and vendors, and keep the right people committed throughout transactions during a company's life. Cass, please take us away.
Thanks so much, Tony. And thanks for bringing communications into this conversation, because so often we're the last to hear about anything that's going on related to an M&A deal. I've had Slice Communications since 2008. I sold it in 2012. I bought it back in 2014, and I've acquired a number of other companies during my time running the company. So I understand the buy side and the sell side quite personally and quite intimately. The first question I want to know from the owner is, what are you excited about? What scares the bejesus out of you? And who are the most important people you need to stay committed through this change? We need to understand all 3 of those things in order to craft a really strategic and thoughtful communications plan that makes sure that the right people are staying engaged for the right reason, and that the owner is really good at communicating even through fear and concern, and that other people understand what's in it for them.
Thanks, Cass. And I think It's interesting because a lot of those foundational and those fundamentals you're talking about, they pertain to the legal side, the financial side, the process side. What's important to you? Who's important to you? We talk a lot about the emotional side of selling a business and the importance of people, culture, legacy for an owner in doing a deal. And fear is part of the emotions that can come into it. And as advisors, I think that's one of our important roles, is to get people, hear our clients out and talk those things through and get to their priorities. Probably 3/4 of our clients come to us with a deal in hand, and we track how we do on those. And it's, we improve those initial offers by 44%. I say that, partially as a commercial, I guess, but also to think about, like, that's a big difference when it comes to financial planning for somebody who's getting ready for retirement. So we'll ask a few more questions here to start out. Cass, why don't we go back to you? When you're putting together your messaging, what do you base it on? You gave us a bit, but what do you base that messaging on as you help your client?
Chances are most owners have a thought in mind about a vision for which they started this company. And so we want to start by understanding that initial vision and how it connects to the moment today. Some owners have also put thoughts into their core company values. And we want to connect with those core company values to help the employees and the stakeholders and the clients understand how those values are going to be continued. So that's where we start. We also really want to look at the buyer and their vision for the company, because ultimately the buyer and the seller need to be very much aligned in the communication to employees, clients, stakeholders in the industry if they're going to be believable. Whenever there's a disconnect between the values or what they're saying or the vision for the company, trust gets eroded right away. And this trust needs to continue and to be successfully transferred in order for the deal to work and in order for people to get the value out of the deal that is the reason they're going into it.
Great. And Jeff, to you. So you talked a bit about this, as did Harry. Hey, ideally you have a couple years ahead to plan. But we know a lot of times that's not the case. Hence the title of our panel today. What do you see going wrong when you do get brought in too late, perhaps even after an LOI signed? And is it too late? What can you do late in the game? Either right before, as a deal is being negotiated, it's in front of an owner. What counsel do you typically give to somebody to help them out in those situations?
Yeah. Ideally your advisors should be involved before it's signed, because, as we talked about a bit, once the LOI is set, most of the economic outcomes are already kind of baked in. The LOI locks in the deal structure, the purchase price mechanics, working capital definitions, if there's going to be rollover equity. So what we often see is, if they're brought in too late, there's inflexible structures on the deal. It reduces the after-tax proceeds. We miss opportunities on the entity structuring. And it's just a bit of a tax leakage if it's not done correctly or proactively. In terms of some of the pre-LOI planning that allows you to take place is really understanding your financials, understanding what your real EBITDA is, perhaps better understanding some of the adjustments in your EBITDA and your valuation, structuring on the tax side, a stock sale versus an asset sale. Just trying to understand some of those things proactively on the front end that allows for a better after-tax cash result for the seller. So, the best planning happens when there's still some opportunity to change things and some optionality before all the exclusivity and structures are already determined and locked in.
Right. So Jeff, let's take that kind of quick turnaround situation where there's some pressure and maybe your client they've already shared income statements, financial statements with the buyer. the buyer's put a number out. Hopefully an LOI hasn't been signed yet.
Mm-hmm.
When you talk about their EBITDA, if you're jumping into that situation, what can you do at that point specifically in terms of the reporting piece and guidance from that perspective?
Well, I think, a lot of things what we can do is just try to understand the financial data a little bit better and explain the revenue numbers and perhaps some of the inconsistencies, or try to, show results that don't show some inconsistencies. We also can kind of come in and show some forecasts in terms of what the future is looking like, because in some cases that might be more relevant and important than the historic financial statements. We kind of identify where there's, customer concentration, maybe some poor documentations on some of the ad backs. So we're really just trying to understand, explain, justify, and correct in some ways some of the EBITDA numbers that we're seeing, and then maybe show a clearer picture for the future growth of the company and what that might be in the buyer's hands.
Right. So you're helping to build the narrative about it's not just the numbers, it's what's behind the numbers. What are the numbers telling you?
Right.
And creating hopefully excitement in the eyes of the buyer.
Correct.
Yeah. So Harry, we talked about the perils of signing an LOI early. An LOI is non-binding. What are the realities of what's binding, what's not binding in an LOI, and the leverage dynamics in negotiation?
Harry, you're on mute.
There we go.
There you go.
It said that I'm not allowed to unmute because participants can't unmute. So anyway,
good now.
Now, Tony, say that again because I was writing that out. I'm sorry.
I can't remember. I know. What I was asking is, with respect to that LOI and when it's signed, what are the realities? It's a non-binding document, but in what ways is it binding? In what ways isn't it binding? And in what ways maybe is it practically binding once it's signed, given the leverage between a buyer and a seller?
Yeah. So generally, an LOI is going to be there's certain provisions that will absolutely be binding, and the headline provision that'll be binding is the exclusivity provision. And what that means is that generally they're anywhere from 90 to 180 days, with 120 being the sweet spot. And what that in essence does is it takes the seller out of the market for a certain period of time while the buyer has the opportunity to do its own due diligence and work on the transaction. So that's an important provision that the seller needs to be made aware of, because once they sign that LOI, they are tied to this buyer for at least some period of time. The other provisions, as you would imagine, confidentiality provisions are binding. Governing law provisions are binding. Sometimes there's a cooperation provision that's binding. That can get a little bit tricky because that can sometimes obligate a seller to engage in good faith negotiations with respect to the deal, whereas sometimes sellers just think they can walk away. But if they've signed a cooperation paragraph that's binding, that can cause problems for them. Really, so and just to backtrack a little bit, in terms of when somebody does bring an LOI to me and it's already signed, or even when it's not signed, I like to have a conversation with them about the economics of the deal, because the economics of the deal, even though they're not binding, are often the stage is set by way of an LOI. When we negotiate terms with another counterparty, they always refer back to the LOI. The purchase agreement is going to be drafted in terms of what the LOI says, and you're really fighting an uphill battle to make any changes from the LOI, because the buyer is always going to come back and tell you that their economics are based upon the economics in the LOI, and to the extent that you change any of those economics, it's going to change the purchase price in the deal. So effectively, what the economics are binding as well. What I do with clients, however, if they've signed one, I would get their advisors involved, their accountant involved, and I'll just go through what I usually talk to all sellers about, which is you need to look at this purchase price. You need to understand what it is, and you need to be comfortable, maybe not happy, but comfortable with whatever gets paid out of the closing of the deal. Because LOIs and deals are also, they're often littered with rollover equity. That can be 20, 15, 20, 25% of the deal. You can have seller take back notes. They can have employment provisions. They can have earnouts. And all of those monies are speculative after the closing. So if a client can't be comfortable with what they put in their pocket at the closing table, it's really time to really evaluate whether you're even going to go forward with this buyer, and maybe sit out the exclusivity period and then get others involved to help you find maybe a better fit or a better buyer for your company.
So Harry, you sign an LOI and you start going through due diligence, and the buyer finds some things that are a surprise. Are they going to say, boy, this was a good surprise, we're going to increase the price, and this was a bad surprise, it's going to be offset a little bit? And for the seller, what leverage do they have? Let's say they got a new contract that's multi-year contract that's really positive for the business. Do they have any practical leverage to go back to the buyer and say, hey, the business has changed for the better, you should pay me more?
Yeah, I think they absolutely do. And part of that initial conversation with any business owner is, and no matter who the advisor is, that they should have this conversation with them, is you can't get married to your deal. Once you're married to your deal, you're not going to get you've lost a lot of leverage in terms of getting your best deal. So if you're married to selling the company, and if you're married to the deal that's there, then the buyers generally will sniff that out, and you're not going to win many negotiations. If you're not married to your deal, you can certainly go back and say, hey, listen, we've just gotten this new contract, or this is going to increase our EBITDA, or you did not include this or that in the EBITDA calculations, or you reduced it by too many expenses, and therefore you're getting a better deal than you're paying for. And just gives you the opportunity to negotiate. And I have had clients do that, actually. And sometimes clients will negotiate a new price. Sometimes they'll keep it in their back pocket for when the buyer comes back with some other issue that they don't want to give on, and then they'll argue, well, you're getting a better deal because of X, Y, or Z, and therefore we're not going to give in on this other issue.
Can I add something to that, Tony? Because there is such thing as a shotgun marriage in a deal, which is when you tell everybody that you're doing a deal and that you're going to sell the company and that these are the terms. You might not want to be married to that deal, but once you start telling people that it is going to happen, you do. Sometimes people feel forced into it. And so the communication during this negotiation time, during this period of exploration, during the LOI to due diligence period, has to be so careful. The words need to be so carefully chosen so that you don't end up in a shotgun wedding to a deal that you ultimately didn't want, because you've set that expectation in your community or with your employees or with your clients.
Thanks, Cass. I was actually gonna ask you a similar question, which is, we talked about confidentiality,
Yes.
Being a binding commitment in the LOI. And given what you just said, how do you think about what's the right way for all entrepreneurs care about confidentiality? I mean, they do. And given that, how do you counsel owners to, who do you let into, to the tent in terms of the information on the deal, or even that the business is being sold? When do you let a buyer talk to your people so that they can vet them? How do you stage announcements? Like, how do you counsel people on the right way to disclose?
That's a lot of questions. So let's start at the beginning. So when you're going through this process of LOI, if you are the seller, there are probably a couple of people that you trust more than anything in the business. That said, confidentiality tends to be a mirage. It is not something you can absolutely guarantee at any time. So know that there is some risk with anybody that you tell about this deal or that you want to work through it with you, and be prepared for that risk, that at any time anything can leak out. For that reason, we ask owners to be very careful, sellers to be very careful with their language. This is something I'm exploring. This is something that I'm talking about. This is something that, is interesting and that I'm curious about. Not something that I'm going to do, right? We stay away from definitive language and from absolutes during this time. It might seem a little wishy-washy, but it makes total sense for entrepreneurs to explore new ideas and explore partnerships. We like to use the term partnership during this time. Oh, we're looking at possibly partnering with this firm or finding ways to do something together in the future. There's lots of that language that we coach people to use during this time. As you get closer and closer to an LOI, and let's say you have the LOI signed, you're going to have to let a couple more people in. And it's important to tell those people at that time what your expectations of them are. And those expectations, sure, you can say the word confidentiality, but like I said, a lot of times people kind of wipe that word away. You as the owner, as the entrepreneur, are used to saying to your employees what your expectations of them are. And so during this time, you've got to reset those expectations, both verbally and in writing, and hold your people to them just like you would in any other situation. A lot of times when you go into the sale process, owners, entrepreneurs are like, well, because maybe they've never done it before and they're not really clear on how to set those expectations. This is a great time to also talk to your advisors. What expectations should I be setting with my CFO, with my COO? What should I say to them in terms of the timeline of this deal and their role in this deal? Because the more they can understand that and take it seriously and take it to heart, the more likely they are to keep it close to the chest and feel those expectations. As you get closer, right around that time of LOI, it's time to start building that communications playbook too. The playbook that says, this is who we're going to tell first. This is how we're going to tell them. This is when we're going to tell them. Here are the materials that we need to develop. Here are the messages about the vision of the future of the deal and how it holds true to our values. Here's what we need to get on the same page with the buyer. So right at LOI, right around that time is the time to start writing your communications playbook so everybody knows what's going to be said to whom and when.
Yeah, just to add to that, Tony, because there's a legal concern there as well. So universally, non-disclosure agreements or confidentiality agreements will impose liability on a seller for disclosure of confidential or any information with respect to the transaction made by the seller, but also the seller's representatives, which would include employees, would include advisors. So the communication is key, and the strategy is key, and communication to your advisors and your employees in terms of their duty of confidentiality is also key in any transaction.
So there are you may disclose you have to stage it, and you may disclose that the business is for sale. Some people may know that. Some people might not find out who it is till it's closed. Cass, I mean, do you see situations where owners tell everybody in the company, hey, I'm getting ready to retire. I'm putting the business up for sale?
Yes. And what happens to a lot of those businesses is that people start to leave because it wasn't set in context, right? There's no idea of like, well, what, and the immediate fear that employees have is that they're terrified. They're scared. That's the first thing. And the second thing is, well, what's in it for me? You're going to retire and sell this business? And the even worse thing is like, oh, are you going to sell it to PE? Because private equity in today's day and age has a reputation for gutting businesses. That may not be true in every case, but that's the normal assumption that's being made today. And so if you don't communicate very clearly about the what, the how, the why, the what's in it for them, people make assumptions and their heads get filled with wrong information. And usually the scariest thing they can possibly imagine is what they think is going to happen. And then the rumor mill starts, and then they start spiraling in their whole minds. And doing something like that is a great way to destroy the value of your company.
Yeah. Jeff, I have a question for you in 1 sec. The one thing I wanted to note is most of our clients have under 200 employees, and the cost synergies, the massive employee cuts, those are part of deals that are hundreds of millions of dollars, billions of dollars. Most of our clients are not having their employees get let go. Most of the buyers of our clients, their biggest issue is finding more good people. So they're reluctant to. They're going to keep if the seller thinks that their people are good, they're going to have a home most likely, and they're probably going to have more growth opportunities over time. So it's not a commercial for PE or platform bolt-ons, but that's been our experiences in this middle market. There aren't layoffs happening when we're selling businesses. Jeff, I was wondering, I had one specific question that I think comes up a lot that I wanted to ask you about in the context of what can slow up a deal in due diligence and closing, and what can even stop it from happening. There are a lot of companies that are on cash accounting, and there are companies that are on kind of modified, not full accrual accounting. And most buyers, most bigger companies have accrual financials. I was wondering if you could talk a bit about your role in helping to smooth those types of discussions.
We do a lot of that type of work, Tony, and a lot of that hopefully is done well in advance. But converting from cash basis to accrual basis financials is key to the process. Just understanding your revenue recognition and smoothing that out throughout the year, so you're not showing the lumpiness perhaps of a cash basis taxpayer. You kind of also want to have the right accounting processes in place to justify to the potential buyer, that you're closing timely, accurately, doing balance sheet reconciliations, things of that nature. So a lot of it is really just kind of tightening up and professionalizing your accounting processes and some of the things that you go through on a recurring basis. We also see a lot more of seller side quality of earnings being done, and that isn't really about only getting the numbers right, but it's being able to show sustainable, normalized, transferable earnings to the new owner. So we do see a lot of that type of work being done in advance that is much more common now than it was in the past, and it's kind of more or less a validation exercise, but understanding what your earnings truly are. Some of the other things that might slow up a deal or kind of sidetrack it a bit is just incomplete or inconsistent financial information, kind of a weak monthly closing process, unclear, customer economics, and just poor documentation on some of the add back adjustments. So, again, it's trying to control the narrative of the financial statements, and, showing a clear picture for the potential buyer in terms of what they're going to be taking over.
Yeah, thanks, Jeff. Here, one for you. Is there, within the due diligence and documentation processes, is there anything that you find sellers are surprised by that they have to disclose or that they have to get approved when they're selling their company?
So some things that surprise our sellers are, what is a contract? So what is always requested is a schedule of what's called material contracts in each deal, and we always, or not always, often get the same answer, which is either I don't have any, or I have 3 or 4, and failing to realize that every purchase order is a contract. Pretty much any time that you interact with a party outside of your business, there's a contract, because contracts are defined as those that are in writing or oral contracts. So that tends to be a big lift and a big educational adventure on our side to help define what a contract is for our clients and help them discern and determine how many contracts they have. And then the flip side of that is, oftentimes, in order to sell a business, those contracts require consent of the counterparty, and that can hold up a deal for weeks. So that is often a thing that you deal with at the very beginning, because you understand, for example, a lease for real estate is one that can take a month or more sometimes to get a consent, and the buyer's not going to close until they get all the material consents with respect to the transaction, which would include many contracts.
Right, and contracts is a good segue, Cass. I wanted to ask you about communications, employees, but there are other other people,
Oh,
other
yes.
stakeholders. Could you talk about that?
Yeah. So the primary way that most clients, stakeholders, the industry, suppliers, et cetera, hear about the deal is actually from your employees. They might read about it in the news, right? That's one way that you'll get it. If you put out a press release and you decide to do that, they'll likely read about it in the news. But they're looking to your employees, their contacts, as give me the real story, what actually happened here. And so while the press release needs to be carefully crafted, and the LinkedIn posts or social media posts that go around along with it should also be carefully crafted. And what I mean by that is that you don't just announce a deal, you set the vision for the future of the deal and you address the what's in it for me for members of the public, including the clients and the industry and the suppliers. So that aside, they're likely going to call whoever they know at your company and be tell me what happened. It's very, very important to arm your employees who at some point might still be in shock. They still maybe just heard about the deal themselves, depending on the communications playbook, to have things ready for them to go. So emails that they can send to clients already crafted, message points that they can have that they can look at and see. Sales leaders, for instance, should be trained in those message points prior to the announcement, the press release going public. They need to have talking points and scripts that they can use to go back and say things to the clients that are aligned with the message. And then they can like improv from there if they want to and like share their own little personal experience. But it is so critical to make sure the press release, the LinkedIn post, the email newsletter, or email announcement, if you're going to be putting one of those out, is backed up by materials that you give the employees to use for their contacts. A whole package, a whole M&A communications package for a group of people who might be finding out this information mere hours before their clients and contacts and customers find out. All of it needs to be packaged up and ready to go, and the managers need to be trained on it in case those employees go, well, what is this? What does this really mean? Or that also enables the managers to call the clients if the employees don't feel comfortable or ready to do so.
Right. Thank you. So we have a little bit under 10 minutes left. And Josh, I don't know if I don't see any questions. I have plenty of questions for if we don't have any from the from guests. So I'll keep going unless Josh, you tell me that I'm missing any any questions that are outstanding. And I think maybe what we should do from here is I'll give you each a question, and Harry, ask you to start, which is if you were sitting next to a trusted advisor, say a wealth advisor, who gets a call from their client, and their client says to them, I just got this offer for my business. It's enough for me to retire. And I think I should take it. They sent me this LOI. If you were sitting on that wealth advisor's shoulder, what would you tell them? And Jeff and Cass, we'll pass it to you after we hear from Harry.
Yeah. So Tony, back to your slide to begin the presentation. We have found over the years that the wealth advisors have become the critical link with respect to many sellers and many business owners. They've done a great job, frankly, creating those relationships. And so the advice I would give a wealth advisor is to have the meeting with the client and start to put together the team. That gives the wealth advisor some input as to who's going to be participating in the transaction, and the team would generally include such things as the attorney, the accountant, a separate tax advisor if the attorney or accountant's not comfortable doing the tax advice, which often is the case. And then also talking to the investment banker, bringing an investment banker in to help evaluate it, or hiring a third party to evaluate the sale or the transaction to make sure that it is fair market that's being offered for the business, and that the multiples are right, that the EBITDA was properly calculated. So really the best advice I can give is to have the advisor help to assemble the team, help the client assemble the team and add value that way, so that everybody is working in unison and comes together at the very beginning of the process rather than halfway through the process.
Great. How about you, Jeff?
I'm going to answer just a slightly different way, though, Tony. But what I would tell the financial advisors is to really start those conversations with your clients before they're ready to sell. A year, 2 years, 3 years down the road, ask them questions about what their timeline is, what their goals are, what do they want to have in terms of after tax cash flow. And then you could start to model some what if scenarios out at certain valuations, right? Trying to understand what the value is now, what the structure of the deal could be, what the taxes could be. You may have rollover equity, and I think you need to kind of play that out, because a lot of times they just hear a gross number and they're ready to act until you go through the process of understanding, what the deal could look like and what the tax bite could be. It might be a different answer. So I would tell them to be very proactive with your clients. Ask them some of these these strategic questions well in advance, and be there to help them plan through that process.
I think it's a great point you make, again, that you're hammering in. And I think one of the things we can do as follow up is, there are going to be these situations where you get that call with some urgency at the same time, helping one another be ready to help one another have those conversations, initiate those conversations early on, which can be uncomfortable. And a lot of times, or sometimes, entrepreneurs don't really want to talk about it until it's happening.
Right.
But it's a really good point you make. How do we start those conversations early? Okay, Cass, what would you say to that trusted wealth advisor who's getting that urgent phone call?
One of the things that's said over drinks or in dark corners in the entrepreneurial community is that selling their business for people who have done it have led to the biggest periods of depression and despair in their lives. Sometimes it's said that it was the biggest mistake I've ever made in my life. And part of that reason is because these entrepreneurs, in a lot of cases, have built their entire personalities around their business. If they are not a business owner, what are they? If they're not an entrepreneur, what are they? And so the thing that I would encourage financial advisors as an intimate, right, of these entrepreneurs is to ask, what do you want to be next? In order to help guide them in that place and not leave them in the depths of despair of, I don't know who I am anymore.
Yeah. That's certainly the case. And the more we can, as a team of trusted advisors, get the entrepreneur to talk about those things. You sell your business. What are the things that fulfill you about your business other than the financial? And how are you going to replace those to continue to be a fulfilled person? I'll
just add to it.
I don't
know, but probably 80% of my clients, they've all called me from Naples in the last month that have sold their businesses, so they don't seem to be doing too bad. So,
good for them. Good for them.
Well, the sun is good for mental health, I think, right? So that's. I do see a question from Chris Fay about asking about valuations where there are high barriers to entry, special IP. We only have a couple of minutes here. I don't know that we're going to be able to get into that in depth. And the other point I should really make is that we're all available for follow-up. And even I see, it's such a great group of people who are dialed in today, in a lot of different disciplines, including, what each of us on the panel does. So we should, certainly feel free to reach out to any of us at any time and talk about specific situations. It just reminds me you look at private equity groups have a ton of money that's flown into acquisitions. We know the population is aging and people are retiring and selling their businesses, and they all need a lot of help. So there's an abundance out there. for us to help clients, help one another's clients. And I really think it's a good ecosystem that we're all part of. So with that, we're at our time, and I really want to thank Harry, Jeff, and Cass for doing this webinar today. It was really great spending time with you. Thanks to everybody for joining, and Josh and Douglas for your help from River Avenue Digital. So really appreciate the time, and we'll be following up with some post-webinar information as well.